we get to subtract out our beginning inventory amount, March the 31st. That's the ending inventory for March, but it's the beginning inventory for April. We get to subtract that to determine the required production of units for April, May, June, and July. All right. Budgeted sales for August is 15,000. 20% would be 3,000, wouldn't it? Desired ending inventory. Any questions so far? Pretty straightforward. So the direct material budget, they tell us there's 5 pounds of materials required in each unit of product. Management desires to have material on hand at the end of each month equal to 10% of the following month's production needs. The beginning material inventory was 13,000 pounds. The material cost is 40 cents per pound. So the required production in units, in April it's 26,000, May's 46, June 29,000. For the whole quarter we have 101,000. The raw materials per unit, we need 5 pounds. We multiply 5 times the units that are required in production to get the total pounds needed. We're going to add the ending inventory, and we're going to get our total needs. We're going to subtract the beginning inventory. So do you see that there's a lot of commonality here? We take what's the required production, we have to add desired ending inventory and subtract out the beginning inventory. That was just like what we did in the previous budget. So we get raw materials to be purchased. Cost of raw materials is 40 cents times the pounds. So we have the total amount needed. For June, we have 23,000 units produced in July, 5 pounds, that's 115,000 pounds, and we want 10%, correct? 10% for our ending. Any questions there on our direct materials budget? Then the schedule of expected cash disbursements. Half of the month's purchases are paid for in the month of purchase. The other half's paid in the following month. No discounts are given for early payment. The accounts payable balance on March 31st was $12,000. Accounts payable at the beginning, we had a beginning balance of $12,000. So it's the beginning balance for April. And it's also the beginning balance for the quarter. We're going to have April purchases. We're purchasing 50% what's needed. All right. And we're doing that for May as well. And May purchases. And then, yes, June purchases. Oh, we only go to June. We can't show July's. Total cash disbursements. We're going to spend $40,000 in April just for this material, 72,300 in May. And June's the same. For the whole quarter, we need $185,000 worth. So that's going to be showing up on the cash budget. And we have direct labor budget. Each unit produced requires 0.05 hours of direct labor. Each hour of direct labor costs the company $10. That doesn't exist today, does it? Minimum wages anymore. Is it $15 in Flagstaff?
For Flagstaff it is, but the federal minimum wage is still like $7.
It's kind of interesting. $7 is all. And
it hasn't moved like in 20 years.
Yeah, you know, there was a group of congressmen wanted to put an index so that minimum wage increase with inflation, which kind of makes sense. But I guess it's a good political football to kick around, you know, instead of instead of solving the problem, that we establish what's considered minimum to survive, and then just have it keep up with inflation, just index it. And then you wouldn't have to have people saying we need more money for minimum wage. We kind of all come together and agree on a certain amount, and then we keep it up with inflation, because we're going to get hit with inflation like crazy because of the money that's been printed by the federal government because of this COVID crisis. The last bill went out $1.9 trillion. It's unbelievable. And then there's trillions of dollars that went out last year in 2020. So, okay, let's see. Management fully adjusts the workforce to the workload each month. So here we go. Required production. We need 26,000 in April, 46,000 May, 29,000 June, and 101,000 for the quarter. Direct labor hours per unit, 0.05. So you multiply that, you get the total direct labor hours needed for each month. And for the quarter, the cost is at $10, so you can determine the direct labor costs. Note that many companies do not fully adjust their direct labor workforce every month, and in such companies, direct labor behaves more like a fixed cost, with additional cost if overtime is necessary. All right, let's see what's next budget. We're just flying through this because we're going to get to a couple exercises or problems here. That's the best. Okay, additional data. Variable manufacturing overhead is $20 per direct labor hour. Fixed manufacturing overhead is $50,500 per month. This includes $20,500 in depreciation, which is a non-cash outflow. So that's important when we determine cash needed, because cash doesn't leave the company. Depreciation is just a systematic, rational approach of allocating the cost of an asset over the useful life. All right. So we have budgeted direct labor hours for each month and for the quarter. The variable manufacturing overhead rate is $20. We're applying $20 for each direct labor hours. So our variable manufacturing overhead costs are calculated. Our fixed manufacturing overhead, they're fixed. It doesn't matter how many units you're producing. So the total manufacturing overhead, and we're going to take out the depreciation to determine the cash disbursements for manufacturing overhead. That's one of the common mistakes students make on the exam. They don't take out the depreciation because it's a non-cash item. Ending finished goods inventory budgeted. So a Royal company uses absorption costing in its budgeted income statement and balance sheet. Well, it's required for financial accounting. We must use absorption costing. We have to absorb all cost in the production of a product, and it goes into inventory, and it only becomes an expense if the inventory is sold. Manufacturing overhead is applied to units of product on the basis of direct labor hours. The company has no work in process inventories. Computation absorption unit product costs. So we have direct materials. There's 5 pounds, 40 cents per pound, $2. Direct labor is 0.05 per unit at $10, that's 50 cents. Manufacturing overhead, 0.05 hours using direct labor hours to apply it at $50 per hour, we get $2.50. So the total unit product cost, $5. So did we absorb all costs? The variable direct material, direct labor, those are variable costs. Manufacturing overhead includes both variable and fixed, doesn't it? So yes, this is under absorption costing. If we're doing variable costing, we would not include the fixed manufacturing overhead. We would expense it off in the time period. Okay, so predetermined overhead rate hasn't changed since the very beginning. It's your They should have the word estimated total manufacturing overhead divided by your estimated total direct labor hours. So they have 252,500 divided by 5,050 hours. So it's $50 per hour. Budgeted ending finished goods inventory in units, 5,000. Our unit product cost is $5. So our ending finished goods inventory in dollars is $25,000. All right. Any questions so far? Selling administrative expense budget. Variable selling administrative expenses are 50 cents per unit sold. Okay. The fixed selling administrative expenses are 70,000 per month, including 10,000 in depreciation. So budgeted sales in units, there we have them. They haven't changed. April, 20,000 units, May, 50,000, June, 30,000. So we still got 100,000 in the quarter. Variable selling administrative expenses per unit. The variable portion, 50 cents, we multiply it. We get the variable selling and administrative expenses. Then the fixed selling administrative, there's 70,000 per month. And then we add it, we get our total selling administrative expense. And then less depreciation. Why? Because there's no cash going out. And we get cash disbursements for selling administrative for each month. That'll be put into the cash budget as well. So the cash budget, a line of credits available at a local bank that allows the company to borrow up to 75,000. So if they're short, they've already made arrangements ahead of time so they can just take what they need. All borrowing occurs at the beginning of the month and all repayments occur at the end of the month. The interest rate is 1% per month, so that would be 12% annually, wouldn't it? The company does not have to make any payments until the end of the quarter. The Royal Company desires a cash balance of at least 30,000 at the end of each month. So if they don't have 30,000, they got to borrow whatever they need to get the desired ending inventory of cash. So the Royal Company desires 30,000 at the end. The cash budget at the beginning of April was 40,000. So they had more than the minimum required by the company. Cash dividends of 51,000 are to be paid to stockholders in the month of April. Equipment purchases of 143,700 are to be scheduled for May, 48,800, and for June, for May it's 143,700 and 48,800 for June. The equipment will be installed and tested during the second quarter and will not become operational until July when depreciation charges will commence. Now comes our cash budget. And this can be overwhelming for students. So we'll do 1 month at a time. Let's see, maybe best to do this, I think. So we start with, what is the beginning balance? So we start with April. The beginning cash balance is 40,000. And I want to emphasize this point because students make this mistake. You don't just add across. For a lot of them, you do. But when it says the beginning cash balance, and we're looking at April, it's 40,000. When we're looking at the quarter begins with April. So it has to be the beginning balance for the quarter. It's going to be April 1st, 40,000. On the exam, people just start adding across, and that messes them up, messes up the totals. They add receipts. What do they expect to collect? Cash collections, 170,000 in April. So there's the total cash available. And then their disbursements, they had direct materials disbursements of 40,000 in cash, direct labor of 13,000, manufacturing overheads 56,000, selling administrative is 70,000, equipment purchase. There's none this month in April, but we do have dividends of 51,000. So the total disbursements of 230,000. Well, the total cash they have available at the end of April is going to be 210. So they're going to have to borrow some money here. So the deficit is going to be 20,000, isn't it? So financing is needed. If you want $30,000 ending balance, right now we have a deficiency. We got to borrow 20,000 to cover the deficiency, and then we got to borrow another 30,000. So we end up with a 30,000 balance. There it is. Total financing is 50, and our cash balance at the end of the month of April.
How do you know how much you're borrowing from financing?
Well, let's look at it.
Is it
Hold on a
beginning of-
second. Let me explain it. You asked a question. Let me explain it. Do you see this total cash that we
Right.
have available for the month of April? But yet we're going to disperse out 230,000. So
Right.
we're short $20,000. If we require a minimum of 30,000 minimum balance at the end of each month, well, we can't just borrow 20,000. We got to borrow another 30. So the total that we're borrowing is 50. Let's see if it works out. If we borrow 50, do we eliminate the deficiency of 20,000, which will leave us a minimum balance of 30,000 there?
Yep.
So that's going to require us a little bit of algebra, right? Or people just use common sense. They won't set up a X equals whatever to solve for it, right? Because
Right.
it's pretty easy.
Pretty easy.
Here's how much we had that we expect to have cash at the end of April. This is what we need for the whole month of April. So we're falling short. We're going to have to tap into our line of credit. And if the company expects or wants to have 30,000 cash at the end, we can't just borrow 20. We got to borrow the 20 and the 30. So that's a total of 50. And let's see if it works out. 50 minus 20 ends up with 30 at the end. Does that make sense? Oh,
Yeah.
People make mistakes with this budget all the time. So I try to point out the areas that this is one of the big mistakes. They just add everything across, because a lot of these you're just going to add across, but not the beginning balance for the quarter, not the ending balance for the quarter. This is the cash balance ending April the 30th. Well, that's not going to be the end of the quarter, is it?
Yeah.
We have to work our way to the end of the quarter. So May is the next month that we're working through. We carry the ending balance of April right here, 30,000. If that's the ending balance, guess what? That's going to be the beginning balance for May. Does that make sense?
Yes.
It should make sense. So let's take a look at the next month. What's going to happen? Well, we have cash collections coming in of 400,000. That was from one of our other budgets, the schedule of cash collections, right? And then we add that, we got 430. We got more than twice as much cash coming in May. But don't we have some extra expenditures? Aren't we buying some equipment this month? So that we'll find out if we have enough cash, or if we have to borrow some more, or if we have enough cash that we can pay back our debt and still have a minimum balance of 30,000 cash at the end of the month. So direct materials, we got a lot more direct material costs this month. Same with direct labor costs, manufacturing overhead costs, they're all increasing because why? Did May, is that the top month for production? Wasn't it 50,000 units? I think April's was 20,000. I think that's the peak. But we also have our purchases of equipment. Look at that. That's a huge amount, isn't it? 143,700. But we do have a lot of cash coming in. Dividends, no dividends. Oh, disbursements are 40,000. We're right at the minimum amount. We got 30,000. We can't pay any of the money back because required to have a 30,000. The company made that requirement, 30,000. Then June, let's look at June. Cash collections plus our beginning balance of cash. We have total cash available, 365,000. We expect to pay 72,700 out in direct material costs. We have direct labor costs of 14,500, manufacturing overhead of 59,000, selling administrative costs 75,000, equipment purchase 48,800, and we're going to have total disbursements of 270,000. But look, we do have an excess of 95,000. We can pay back what we borrowed. When did we borrow it? They said we borrowed the 30,000 at the beginning of the month, and we're paying it back at the end of the month. So that meant we had how much in borrowing? $50,000. Starting April, so all of April is 1 month, all of May is the second month, and we pay it back at the end of June. So we have 3 months. So if it's 1% per month, 50,000 is what we borrowed. They said all borrowings are on the first day of the month, and all repayments are made at the end of the month. So at the end of June. So 3 full months, 1% per month. We have $2,000 in interest. It's additional cost of doing business, isn't it? So we end up with an ending cash balance of 43,000 for the quarter. Let's do this last column. Well, I emphasized you better not be adding the first row, because we're telling the readers the cash balance at the beginning of the quarter is 40,000. What's the beginning of the quarter? April the 1st. Okay. How about cash collections? Can we add those across? Sure. Because we collected 170,000 in April, 400,000 in May, and 335,000 in June. So for the quarter, we collected 905,000. The total cash available to us, we took the beginning cash balance, the cash that we expect to collect. So that's total cash available of 945,000. How about our disbursements? Notice they don't show depreciation on here because there's no cash. We don't write a check to Mr. Depreciation. So we can add these across. 40,000 plus 72,300 plus 72,700, we get 185,000. The next is 50,500. Manufacturing overhead in total is 191,000 for the quarter, $230,000 worth of selling administrative costs. Our purchases of equipment, 192,500. Dividends, we had 1 month, 51,000. So 900,000 less cash available. We get 45,000, don't we? And then how much did we borrow during this quarter? We borrowed 50,000. How much did we repay? We did repay all 50,000, and the interest we calculated 2,000. So if we subtract that, well, 45,000, this is a wash because we borrowed and we paid it back. So we're going to subtract 45,000 by 2,000. And there's our, well, here they subtotal this. So they subtract 2,000 from 45,000. And guess what? This better equal that, right? If it doesn't, you made a mistake somewhere, because this is the ending. June the 30th is the last day of the quarter. So there you have this as your check. And if something doesn't add up, well, maybe you added this line across, or you made a mistake somewhere. You added in depreciation. You forgot to subtract it out or something. Hey, any questions on that cash budget? That's a big one. You're going to have to know that one. Practice.
When we get that on the test, is it going to have all the lines for us and we just fill it out?
Well, maybe now that you're growing as an accounting student, you could do it on a blank sheet of paper like this. Would that be good?
No.
That would be a great challenge.
It would.
for our
Okay.
accounting
Don't get
majors, because guess what? On the CPA exam, this is what they got, a blank sheet of paper, and they got to fill it all out. So students complain like, why do I got to memorize? Well, because I'm training the people that are going to be sitting for the CPA exam. And guess what? If you're not an accounting major, this is the only time. You think this is difficult, wait till if you're in accounting and you take the advanced level courses on determining earnings per share. That's pretty complex. They have some very complex topics. They have a lot more inventory methods. They have the dollar value LIFO method of valuing inventory. It gets pretty complex, very technical. So anyway, that's why I do it. But will I provide lines? Probably, because the shortness of time is a factor. And if I'm going to test all the concepts that are important in these 3 chapters, then I will probably have it a template like I've done for the most of the problems. Isn't that a correct statement? All right. I like to be a little dramatic. Don't tell you a straight answer, right, Vanessa? But you're used to that. You're used to that. Okay, so now budgeted income statement. It looks just like income statement, right? You got your net sales, cost of goods sold, gross margin, selling administrative, net operating. So your selling administrative costs will include depreciation here on an income statement, but not on the cash budget. I can't tell you enough how students mess that up. Don't be one of those students that mess up depreciation. Yes, depreciation belongs on an income statement, and accumulated depreciation belongs on a balance sheet, whether it's budgeted or if it's an actual. But for a cash budget, you don't show depreciation expense. You don't show amortization expense. And you don't show depletion expense, because those are non-cash expenses. For a cash budget, you're focused in on cash expenses. Okay? So here's how they came up with net sales. Everybody knows sales minus the uncollectible amounts. Net sales, yes. Computation of cost of goods sold, budgeted sales, unit product costs. They're going to have 100,000 units. If our product cost is $5 a unit, that's simple enough, right? We know how to do that. It's a little bit of arithmetic, multiplication. How about the balance sheet? Oh yeah, they have it broken down into a classified balance sheet, don't they? Current assets, plant and equipment. So they have 2 categories. This is from the different budgets. They reference it. Accounts payable, common stock, retained earnings. There you have it, the different budgets. Oh, this is got a, oh, I have, oh, well, why do I have 2? Do they
One's
require?
March, one's June.
Oh, and then is there going to be just those 2? They didn't have April's, right? They had March, because I guess that's the beginning balance,
April.
right? This would be the beginning balance sheet for the quarter, and this is the ending balance sheet for the quarter, because this is June the 30th, last day. Well, March the 31st, if this is March 31st, well, April 1st is going to be the same thing. All right. Any questions? You read it. We went over it. Now let's start doing some problems. So let's see how much time we got. We got time. You guys can start doing part of this now instead of just watching me do it. You've seen it, you've read it, you've heard it. Now let's see if you can apply it, because that's what you have to do when if we have our homework and on the exam. So let's go to page 397, exercise 8-14. So go there and follow along.
Did you say
So-
8-7, Ed?
8-14. I
Oh.
might have said 8-7. Did I say exercise 8-7? But it's exercise 8-14. It was page 397. The marketing department of Jesse Corporation has submitted the following sales forecast for the upcoming fiscal year. Oh, so instead of months, they give it to you in quarters. First quarter, they expect 11,000. In the second quarter, 12,000. Third quarter, 14,000. Fourth quarter, 13,000. So you can show a total column for the budgeted for the year. The selling price of the company's product, $18 per unit. Management expects to collect 65% of the sales in the quarter in which sales are made, 30% in the following quarter, and 5% of sales are expected to be uncollectible. Okay. The beginning balance of accounts receivable, all of which is expected to be collected in the first quarter, is 70,200. The company expects to start the first quarter with 1,650 units in finished goods inventory. Management desires an ending finished goods inventory for each quarter, 15% of the next quarter's budgeted sales. The desired ending finished goods inventory for the fourth quarter is 1,850 units. So the first requirement is calculate the estimated sales for each quarter of the fiscal year and for the year as a whole. Oh, you should be able to do that. That's the easiest thing we got to do in our budgets. That one's so easy, I don't know if I'll even ask it. Go to work on it. I'm going to get a drink of water while you're working. Okay, who has a number yet? Should have a number by now for one of the months, or I'm sorry, one of the quarters. This is the easiest budget.
Quarter one saw $198,000 in total sales.
Yes, for the first quarter. How about the second quarter?
216,
And the third quarter?
252,
Fourth quarter.
234,
And for the year?
900.
Very good. It's not hard to do that. It's the simplest budget we have to do. Simply the budgeted units in sales times the selling price per unit. Any questions? Okay, no questions. Let's go on to the next requirement. Calculate the expected cash collections for each quarter of the fiscal year and for the year as a whole. Oh, go ahead and work on that. You got to be reminded that the company expects what at the beginning of the accounts receivable expected to be collected for the first quarter, 70,200. All's going to be collected in the first quarter. So that's one that you need information on, right? They tell you they collect 65% of the sales in the quarter in which the sales are made. Oh, okay. So we have the total sales, 65% is collected. So in the first quarter, what is that? 198,000, 65,000 should be, or 65% will be collected. We could do that easy enough, right? So it's just a matter of following what's given you in the problem. So let's take a look at the first quarter. So that's 70,000, that's going to be collected, just like I said, and then 65%. Oh yeah, because how much is the quarter sales? 65%. Yep. And then 30% in the next month. So let's take a look. 30% of the first quarter is going to be collected in the second quarter. 65%, isn't that 216,000? The second quarter sales times 0.65, that's 140,400. Yes. And you just do that all the way across. So that's not difficult either. You just got to know what the problem's telling you. Questions on preparing a schedule of expected cash collections. You're probably going to have to do one for homework, I imagine. Yes. Any questions? Is this simple for you, budgeting? Okay, some people are nodding. Yeah, it's not very hard. It could take time. It could be time consuming when you have multiple products. And then calculate the required production in units. Oh, finished goods for each quarter. So this is one of those that what is expected to be produced, what's the desired ending inventory, we add to it and subtract the beginning. So there's several of these budgets that are that way. This is that way. Makes sense because you're determining the required production requirements for each quarter. So you're going to need to know the number of units, right? The number of units in each quarter. Well, that was given here in our sales budget, 11,000, 12,000 units, 14,000, 13,000, total for the year, 50,000. So let's put that down. The budgeted unit sales for each quarter and for the year. That wasn't hard. That was given. And then what's next? We have to put in the desired ending inventory of finished goods. And remember what they told us? They wanted what? For the first quarter, 12,000 units times 15%. That's right. So that's where we get 1,800 and so forth. So there's our total needs, subtract out the beginning inventory. Beginning inventory is last period's ending. Yes, for the beginning first quarter, 11,000 units times 15%. Oh, that would have been the desired ending inventory for the fourth quarter of the previous year. So that's the beginning, 1,600, and that's subtracted from the total needs. So the required production units is 11,150. And we do that for each quarter. Shante, you feel comfortable with this?
I think I'm getting it down.
Yes, you look like you were working on it. That was good. Okay, any questions? Exercise 814. How critical is it to read carefully? That's what it comes down to, isn't it? If it's their desired ending inventory is 15% of the next month's production or budgeted sales, then you got to make sure you're multiplying 15% times the right numbers. All right, let's go on to the next problem, which is lengthier, takes us longer, probably harder. And that's going to be on page, let's see what page number that is. That's going to be on page 401. 401 pages of knowledge. Are you getting your money's worth in this class? Or do we need to cover twice that much material? Or do you think we're covering enough material as is? Well, I hope you feel you're getting your money's worth. So problem 8-21. Let me repeat that. Tyler, 8-21. That's the problem on page 401. They want us to do schedules of expected cash collections and disbursements. And in their requirement, 1, calculate expected cash collections for December. 2, calculate expected cash disbursements for merchandise purchases for December. And then 3, prepare a cash budget for December. Indicate in the financing section any borrowing that will be needed during the month. Assume that any interest will not be paid until the following months. So I didn't read the details of this problem. I looked at what's required, and I know what's required. I have to calculate expected cash collections for the month of December. I got to calculate the expected cash disbursement for just merchandise purchases. And the last requirement, prepare a cash budget. And I recall you start with the beginning cash, and then how much cash are you collecting? That gives you the cash available, and then what cash disbursements that you have. And then you total that, compare it to cash available. It would tell us if we have a deficit or if we have excess cash for the month of December. And then we can determine based on requirements in the problem, what do they require for a minimum cash balance? So let's look at the details now. You've been asked to prepare a December cash budget for Ashton Company, distributor of exercise equipment. Following information is available for the company's operations. Cash balance on December 1st. So that's the beginning cash balance. That's what I got to start with, 40,000. Actual sales for October and November, and expected sales for December are as follows. So they give you actual October, November sales dollars, but then December's is a budgeted amount. They have cash sales for October 65,000. So those would have been received in the month of October. The November cash sales. So those are going to be irrelevant to preparing a cash budget for December. But the cash sales for December is relevant, $83,000. Sales on accounts, well, that's going to come into play because sales on account are collected over a 3-month time period. So if you have sales on account in October, it's going to be collected in October, November, and December. So let's see the specifics of that. 20% collected in the month of sale, 60% collected in the month following the sale, and 18% collected in the second month following the sale. The remaining 2% is uncollectible. So if you got sales in October on account of 400,000, well, 20% would have been collected in the month of October. 60% would have been collected in the month of November. That means 18% we're going to show being collected of October sales being collected in December. And then November, 20% is the sales on account is collected in November. 60% will be collected in December. All right, so can we do this? Let's see. We got to do those expected cash, right? How much expected cash do we going to have? December cash sales are 83,000. Okay, that's easy enough. And then October sales had 400,000. So let's see. Cash sales December, cash sales. There you're going to get $83,000. That's simple enough. From October sales, it's going to be 18%. So you got to look at, October, our accounts, so sale on accounts are 400,000. 18% is going to be collected in the month, the second month following the month of sale. So December, 400,000 using my dollar calculator times 0.18. Oh, this calculator. There it is, times 0.18. 72,000. Is that what you got? And then November credit sales or sales on account. Sales on account. They are showing November 525,000, of which 20% collected in November, 60% collected in the next month. So 60% of 525,000. That should equal $315,000. So we got October's, November's, we got December's cash sales, but we also have sales on account in December, right? That's 600,000. So December sales on account, 600,000. And in the month that we sell it, we're collecting 20%. So that should be 120,000 without a calculator. Let's see if I got that. Let's see, that was 315,000 have to be added to the 72,000. And then we got the 83,000 in cash. And then we got another 120,000. So what does that equal? What's the total? What's the total? Did I get 590? Did anybody else get 590,000?
Yes.
So that is the total cash collected in the month of December, correct? I'm doing this without any lines. I'm just doing it on a blank sheet of paper. This is how we had to do it back in the day. So I just require the same thing that was required of me. And it's considered torture today by some people. That's not hard. And then what's expected cash disbursements? What do they tell us about our purchases of inventory? 30% of the month's inventory purchases are paid during the month. The accounts payable remaining for November's inventory purchases of totaling 161,000, all of which will be paid in December. Okay. So they made it easy, didn't they? They made it easy because they're collecting some in the month that they purchase it, or not. Yeah, they're paying for it, and then they're paying for the rest of it in the following month. So let's look at it. 30% of the month's inventory purchases are paid during the month of the purchase, and then the accounts payable remaining is all paid for in the next month. All right. So November purchases, 100 and so the inventory, that's 161,000. November, 161,000. It's all paid for. That's what was owed, paid in December. Next, December purchases. How much did we purchase in December? Let's see, purchases of $280,000 in December, of which 30% or 0.3 would be paid for in the month. So 28,000 times 0.3 or 30%, you get 84. Did I say 84,000? Yes. 84,000. And then our total cash disbursements. Just add them together. $245,000. All right. And then what else? They tell us selling administrative expenses are budgeted at $430,000 for December. Of this amount, $50,000 is for depreciation. Wow, I got to subtract that out, don't I? The rule is only cash expenses if the total selling administrative is budgeted at $430,000. You're going to subtract from it $50,000 because you're not paying $50,000 out in cash. So that would be $380,000 for selling administrative. And then they have to buy a new web server for $76,000, and then they pay dividends of $9,000. So our disbursements would include our $245,000 for our supplies, payment for inventory, and then selling administrative expenses, $380,000. We subtracted from $430,000, the $50,000 depreciation expense, and then we have another $76,000 when we purchase a new web server, and a dividend of 9,000. So that totals 710,000 in total disbursements. So if we subtract that from the beginning amount of cash available, remember, what's the beginning cash balance? Somebody tell me the beginning cash balance.
40,000.
Oh, so that's the starting point for the month, is it not? Oh,
of
let's see.
December. Yeah.
So I have it way over here, beginning cash balance. And then we're going to add cash collected, right? Cash collected is 590,000. Here it is here, 590,000. So this is the cash available. So that's going to be $630,000, right? And then what's our disbursements? Well, we got 245,000 for inventory, and then selling and administrative 430,000 minus the $50,000 of depreciation. Selling administrative is 380,000, and then a new web server of 76,000, and then dividends of 9,000. So let's add up all of those disbursements. So 245,000, 380,000, 76,000, and 9,000. So is that 710,000 total cash disbursements? Oh, cash available, 630,000. We're going to have a deficiency here, aren't we? Is that $80,000 deficit?
Yes.
Oh, so how much do we have to borrow? What's it say they want for an ending cash balance? Company maintains a minimum cash balance of 20,000. So we got to borrow 80 plus another 20. So we're gonna have,
100,000.
yeah, we're going to have to borrow 100,000. So then we get an ending cash balance of $20,000. That's my chicken scratch. I don't know if you like me doing it that way, but I could show you a nice, pretty picture here of how they had their solution. Here's the cash budget. Here's the beginning cash. Here's the cash collected from customers, total cash available. Here's all the items we're going to pay cash out in disbursements. We got to pay cash for inventory. We got cash on selling administrative expenses. We got to buy a new web server, and we got dividends. But remember, the selling administrative cost included $50,000 of depreciation expense. That's a non-cash expense, so we got to subtract that. That's how we got 380 here for selling administrative. And so the total cash disbursements are greater than the cash available, so we're short 80,000. We want $20,000 balance. We got to cover the deficiency, so that's 100,000 we got to borrow to get an ending balance of 20,000. Questions on a cash budget? We're 2 minutes over. We're 2 minutes over budgeted time, but I don't think people mind getting free minutes with their tuition dollars. But anybody that wants to stay, because some people have to go to their next class, or maybe they have a doctor's appointment, I'll be glad to stay after class for a few minutes to answer any questions. Okay, questions. Clarissa, you usually have good questions. What question do you have here in this chapter on budgeting? You don't have any questions, Clarissa? That's hard to believe.
I don't think I have any questions. The production budget has me a little bit confused, but
Here it is. How many units do we have in our budgeted sales in units? What is the desired ending inventory in units? So we know the total units in totality, but we get to subtract the beginning inventory in units. All right, so that's what I do. There's that theme where there's several of the budgets. What do they expect? What do they desire in ending inventory? And you subtract the beginning inventory. There's about 3 or 4 of those. Production budget's one of those. You'll get it through practice. And how many problems do we have due for Thursday? 3 problems? Let me check to see if you have to do the master budget problem. So you have to do problem, let's see here. Do I have it marked in my book? Problem 8-29. And what else? Is that maybe that's the big one. Yeah, that's the one you got to do. Is that the only one you have to do is 829? Or what, Vanessa?
Well, we did,
Oh, we did 2 of our homework problems today?
2 of our homework, so
Oh, darn.
technically, yes.
I stole that from you. Do you want me to give you 2 more?
no, I think we're
Oh,
good.
okay. Well, you got the monster master budget where you're going to do every single budget. Isn't that going to be fun? But you got 2 less problems you have to do because I did them for you.
Perfect.
So
Thank you.
you never, when I throw people a bone, they usually don't acknowledge, well, thanks for helping us out.
I wasn't gonna say anything just in
No,
case.
yeah, okay. Since nobody appreciates it, I probably will never do another homework problem for you again.
Oh, no, I do. Thank you.
That's the way I am. You know how I am.
Yes.
Thank you,
Okay.
Ed. I'm
Well,
Vanessa. I thought you didn't know, so I didn't want to say anything.
No, I knew what I was doing. I was throwing you a bone because the master budget's going to take you some time. And the one thing I'm going to give you a hint, you have to figure out the cost of goods sold. So if you're given the gross margin percentage, you could tell me what the cost of goods sold percentage is, isn't it? The sales minus your cost of goods sold percentage gives you your gross margin percentage. So there, that should make it easy for you because a lot of students get stumped on that. So I threw you another bone too. It's just a little like a wing, chicken wing bone. But that stops some students. They can figure it out. How do you get cost of goods sold? They just give us sales. Well, they give you the gross margin or gross profit percentage. You got to subtract that from 100% to get your cost of goods sold percentage. And then you can take that, multiply it by your sales dollars, and you get your cost of goods sold. There, I said it. You can thank me one day for that too.
Thank you, Ed.
All right.
Thank you.
All right. Very good. So anyways, you got 1/3 of the class ahead of you. You want to stay on top of this because anytime you just kind of like, oh, I'll just kind of go and